Realty Income, the big, the bad, the strong, the powerful, the long-term, the enduring company, the monthly payout company. They've got a strong starting dividend yield. What could go wrong, and do we have any better options? Agree Realty, the smaller, the scrappier startup. Now we've got here a company that prioritizes the quality of their portfolio. Is this a better alternative for me in my portfolio than Realty Income? Let's get into it. We're going to go head to head, and I'm going to explain the logic and the rationale for the decisions that I have made in the last couple of days. Let's get into it. Okay, so one of the big things that I do love about Realty Income is this is a beast. It is a machine. If we turn down here to the analyst scorecards, we can see that the company provides good guidance, it's reliable, and it gets the job done. Analysts are able to estimate the AFFO very well 1 year and 2 years out. That means they have reliable estimates. The company provides great guidance, clear guidance, and the company goes out there and achieves what they're guiding to very well, allowing analysts to understand both the industry as well as this particular company. What this means is these dotted orange lines here, these future forecast estimates, are likely to be reliable and are likely to be numbers we can trust. Now, one of the key things here is the company is slowing down in their growth. So one of the big challenges here is this growth rate. So we can see here 4%, 3%, 2% for coming years. The company is big. Now we can see a couple of past growth opportunities here, such as in 20 acquisition, my friends, a big acquisition there. Talking about a $3.2 billion acquisition of American Realty Capital Trust, in addition to their other standard acquisitions. 2021 and 2022 were also periods of strong AFFO growth. We saw the merger with REIT, all-stock transaction, and of course the spin-off of Orion Office REIT at this point as well. Now that did a couple of things. Getting rid of the office REITs from this company allowed it to be a bit more concentrated. However, one of the challenges of this approach is, of course, that as they acquire these other REITs, they're taking on, in essence, the full gamut or the full range of what those REITs have to offer. As a result, in my mind, during these periods of strong acquisitions, in general, the portfolio quality is going to go down. In the past, certainly in the early 2000s, most of this acquisition and activity during this period has been through acquiring strong, good, solid, high quality real estate. The challenge with a strategic acquisition during these periods is it lowers the overall quality that Realty Income has on hand. Is it a big issue? No, it's not a huge issue, but it is diluting the quality of the portfolio. Now, in contrast, one of the other companies I like is Agree Realty. It's a very comparable net lease REIT, and it's historically focused on higher quality assets, and they have very clearly stated they're not going to change this focus. They're going to maintain a high quality portfolio. Now, another challenge here is the simple size of the company, $46 billion. This is big. What that means is to maintain growth rates, it has to essentially go out there and make these strategic acquisitions. So this is the same problem essentially stated a different way. The only way to grow is to acquire properties, and as you acquire properties, it will dilute the quality of the portfolio. Now, as this happens, it's also losing focus. Now, I've made this point before as well, particularly with the recent acquisitions and strategic partnerships in data centers and casinos. It feels as though the company's losing their way, they're losing their focus. It's becoming more diversified rather than a strong single sector here on retail REITs. So what is the answer? Again, this is not a bad company. I think you could buy the company at the current price, and I think you could do very well. So even if we look at the current forecasting, switch this to a normal multiple of 18.5 times, it would suggest that if the analysts have these forecasts correct and the company returns to the same ratio of price to AF, we could be talking about a 21% annualized rate of return. Now, I'm not 100% confident that the company warrants this type of valuation anymore, but even if the valuation only improves somewhat to, say, 14.8%, which is definitely not taxing, we're talking about a 12.5% annualized rate of return, which is a combination of a multiple expansion as well as dividends. But can we do better? Let's have a look at what I think is the best option here, the alternative, which is Agree Realty. Okay, Agree Realty, ADC. Again, we are on fast graphs, and I want to have a good look at the fundamentals here. Now, the fundamentals are not quite as strong as what we saw with Realty Income. Now, one of the issues here is we saw good growth throughout the GFC here and the AFFO, and then we saw the drop, and we also saw a drop in dividend, which shook, I think, many investors in the company at that point in time. Since about 10 years ago, we've seen this slow and steady march here in the AFFO. It's been growing 2, 4, 7, 5, 8, 5, 7, 6, 10, 9, 3%. We've seen that the dividends are increasing. Now, the dividend increase rate has allowed a slightly better payout ratio here. It's now looking at about 73% as opposed to 77%. So they're maintaining and slightly improving that payout ratio. We can see here as we scroll down that it isn't as beautiful here in terms of the analyst scorecards as Realty Income has been. It's been mostly hitting, but there's been a couple of misses out 1 and 2 years. Now, as we go through, we can also get a sense of when these were, and we can see here in the last 10 years at least, it's been looking very good and 100% hits here. So these earlier misses, I'm guessing, are probably going back to that period here, post-global financial crisis and just after 10 years ago from today. And so this is what I think is a better option. This is where I've decided to put the funds. I have sold out of Realty Income and invested in Agree Realty. Now, one of the nice things here with Agree Realty, it is smaller, so it's only 5 billion. It does have a BBB S&P credit rating, and again, it's got good long-term debt to capital, so not taking on too much risk. So what can go wrong here? The dividend yield is not as strong. It's just over 5%. And the price to AFFO ratio is not as favourable. It's not as cheap, shall we say, as Realty Income. Now, the forecasting, if we switch to a normal multiple and we're looking here at prices returning to a normal multiple of 20 times, and we assume the analyst estimates are maintained and the company does reach that level of AFFO and the prices do return to this ratio, we're talking again about a 21% annualized rate of return. So almost identical from this point to Realty Income. Now, is the company going to return to 20 times? I said in my mind that Realty Income wouldn't reach necessarily the same AFFO multiples as it has in the past. But even if we discount here to a very reasonable 16 times price to AFFO multiple, we're talking here with Agree Realty at about 12.3% as a total annualized rate of return, which I still think is manageable. One of the things that I do like about Agree Realty is the growth. It's not through massive acquisitions. So we're seeing just small organic growth here. We're talking about a company that is still maintaining and prioritizing the quality of their portfolio. Now, I think there are perhaps some other options here that you could look at. If you're looking for very near-term income growth, you could look at NN or the NNN REIT, as it's now called, which also has a very strong history of dividend increases and a strong dividend payout at the current dividend payout. But I like Agree Realty as a replacement for Realty Income. We can also see in recent years that the dividend growth rate has been good, strong, mid-single digits. So I'm talking about some good dividend growth rates. I'm talking about a good starting dividend growth rate here. I'm talking about being able to capture this growth here as it happens of about 4% going forward, plus the 5% dividend yield. I'm talking about a sort of a 10% gain in the value of my investment from both dividends as well as enjoying and participating in the growth of this real estate investment trust. Now, switching over to the Koifin platform for a little bit more data here, we can see here the analysts rating it generally a buy or a strong buy, with some rating it as a hold. I definitely fall into the buy camp here. When we begin to look at the percentile ranks, this is one of the features here of Koifin that I do. We can see here in terms of the valuation multiples, it's looking like good value. It's not perfect value here, but it's looking like it's generally good value, with most of these indicators here flashing green. And leverage here as well is generally looking good. Particularly here, the long-term debt-to-equity ratios are looking like it's good versus the last 10 years, so it's not looking like it's got too much leverage here. And again, when you're looking at other real estate and US and Canadian real estate as well, it looks like it is performing well against those REITs as well. Now, of course, one of the other powerful things about Agree Realty is they've also switched to this monthly dividend payout, which doesn't make too much difference mathematically, but it just does feel good to get those monthly dividends coming in. Now, I have limited capital, like I think all investors, limited capital, and so it's always necessary to make sure that we're investing for the best bang for our buck. And so in my mind, switching from Realty Income to Agree Realty is a like-for-like swap. I did have both of them in my portfolio. I have essentially sold out of Realty Income for Agree Realty. I see it as a slightly lower risk with more upside potential because of that growth. Looking here at the forecast growth here, 4, 3, and 2% growth slowing down as opposed to Agree Realty here with the higher quality portfolio that's going to grow organically, smaller scale, while maintaining the quality of their portfolio. That's what I've opted for. Now, that's a decision I think is right for me, and I can certainly see where Realty Income could very well be an excellent choice for many investors. Now, I'm thinking here, particularly it's got that higher dividend yield. I don't think this is a company that's in any danger of going wrong or going badly or disappearing anytime soon. So if I was in retirement, I was looking for better income, greater stability in the income, I would probably be all in Realty Income. However, in a like-for-like swap here, I've switched to Agree Realty because of what I see as slightly less downside risk, slightly more growth potential, and this is the core of this decision. Now, when we're looking at the Koifin platform as well and looking at, for example, the charting here, we can see that both individual stocks of O and ADC, they're more volatile than the S&P here in purple, and we can see greater performance over time. Now, of course, this is since sort of 2000. If we switch to a 10-year time frame, we can see the picture changes a little bit more, and we can see over the last 10 years that ADC here in green has been outperforming generally both the SPY as well as Realty Income. There's been periods where they've marched in lockstep here, the two REITs, but performance really, I think, diverging here before the pandemic with Agree Realty, and also post-pandemic, generally fairly strong as well by both REITs. And if we switch through to post-pandemic recovery, we can actually see ADC and Realty Income more or less following the same path here, with SPY surging ahead in 2023 and 2024. I'm looking at this. I'm looking for these periods of outperformance here in terms of the price for ADC moving forward. I'm looking for these periods where it is going to outperform, it is going to return me a stronger long-term rate of growth. And I'm not talking about a strong, massive, an additional 10% over Realty Income per year. No, I'm talking about small amounts of growth compounded with time.